It's 26 March 2020, and I'm just going to go over our market update of today. There's a lot of conflicting ideas between what's going on in the market right now because we've had a couple up days and what's really going on in the market. And it just has to do with people taking a micro or just a zoomed in view of macro, like 1 day, 2 day, 3 days, versus the overall trend. So there's an old saying called the trend is your friend. You're supposed to follow the trend. So what happened today, it's not that important as of what happened over the past 30 days, 60 days, 90 days, 1 year, 2 year, 5 year, right? So obviously today was an up day, like the Dow went up 6%, S&P 500 6.2%, the VIX is at 58. It's falling. In the last, the VIX hit about 85. If we look at the last month, the VIX was 85, so that's the volatility index, just how crazy the market is. On average, when you zoom out in the past year, you're seeing, 13, and then when it gets really crazy, it's 15. All of a sudden, we're up here. So the VIX is down, which would imply that people are getting more complacent or they're getting used to the market going up and down, and because the last 2 days have been up, the VIX has gone down, but that's just short term. So go back to the markets today. Utilities is the best. So utilities and real estate in quad 4, which would be when earnings are slowing and inflation is going down. The reason why is prices. You can't charge high prices when people have no jobs. You can't charge high prices when there's no demand. So prices of things go down, and we're in a crash. So when you're in that kind of market, the only things you should be investing in is utilities, real estate, and healthcare. Obviously, those are the ones that are up. The ones that you want to be shorting are energy, materials, consumer discretionary, and tech. So today they're up, but I'll show you the performance year to date. So if you look at today, the developed markets are up 4.5%, UK is up, France is up, Australia is up. So this is why everyone is all of a sudden saying, now is the time to buy. Susie Orman said today is the time to buy. I think I have that article. Here we go. So Susie Orman says there couldn't be a better time to start investing than right now. Okay, so I just showed you the VIX. So the VIX is 58. It's some of the highest levels it's ever been. Volatility is the highest levels it's ever been. And Susie Orman is saying this is the best time to invest. It's not. If you're new to investing, having high volatility like this, all it does is cause the market to whipsaw up and down, up and down, up and down, and you're scared. And then it causes you to sell your position prematurely, usually for a loss. Now, in the future, when the VIX goes back down to normal, once we're done this, which we're going into depression or a recession, a technical recession, which could last 16 to 18 months, and I'll show you why we're going into a recession, then it would be a good time to buy. So right now, it's just a good time. If you're new and you're not in the market, you shouldn't be in the market right now. It's too volatile. You should just be saving money. Doesn't matter what she says in this video. It's crazy that someone would come out and say that. I think she's just looking for clout. So let's go into the news and see why the news seems like the market is bouncing back, other than the fact that the last 2 days were green. The last 2 days being green were up 9% when the market was down 30%. I'll look at that one last. Don't really need to see that. So, number one, G20 leaders inject $5 trillion into the global economy to fight coronavirus. So the leaders of the G20 economies inject $5 trillion. Most of that is just the U.S. Canada injected $82 billion. The U.S. injected $2.2 trillion in the coronavirus stimulus bill, but they had already been buying treasuries for another $2 billion, and then the rest of the world added up to $1 trillion. So the point of this is to get the market going, get some liquidity into the market, but also put money into people's hands through helicopter money. The reason why they're putting money in people's hands is in 2008, there was a stigma about the bailout that Obama did and also the bailout that George Bush did, was that companies misbehave and mismanage their money, and they're rewarded in 2008 with billions of dollars. So the helicopter money theory is that they're going to drop money into the hands of the people that need it the most, and they will spend the economy into prosperity. There hasn't been a time where helicopter money alone has solely brought the economy back, but it can help if it's done at the same time as printing money, buying bonds, buying stocks, all at the same time. Meanwhile, hopefully the economy will go back. But the problem stopping this from going back, they're putting the horse before the cart, or the cart before the horse. The market goes down, as it's been going down 30%, I believe, in the last 30 days. So if we look at world indices, so if we look at world indices, now here you can go to year to date. So Brazil's down 32%, the Dow is down 20%, the S&P 500 is down 18%, the Nasdaq is down 13%. Now you look at Asia, India 31%, Australia negative 24%, Korea negative 22%. So look at Europe. Europe is hemorrhaging. This is crazy. So Europe is hemorrhaging, and look at Africa. Africa is not doing well at all. So year to date, the market is getting destroyed. This would be a crash. So if you look at the economic playbook, the way to cure a crash is to stimulate the economy by throwing money at the economy. So Trump says, we have a coronavirus problem. Let's just throw money at the economy and that will get the stock market back up. It doesn't work that way because people aren't working. People aren't leaving their house. So these are the states in red that are ordered by law to stay home unless they're going, and also close all of the businesses. That's over half of the USA. And when you look at California and New York, California and New York alone, and Texas is fine, but California and New York alone, that's more than probably 50% of the U.S. GDP right there. And then the only other states, you have Florida and Texas that do a lot of business. So they're on lockdown. Pumping $2 trillion in the economy doesn't do anything. You're going to put $1,500 in everyone's hands, and the only thing they can do is pay rent with it and maybe buy groceries. There's no people buying Lambos. There's no people buying BMWs. There's no people buying diamonds. There's no people buying clothes. Like, they're buying what they need, and that's it. So by doing so, the market is bouncing. So if you show here, yes, the market is bouncing on a 1-2 day. So you're looking at the last 5 days, the market is bouncing because of this announcement. However, the market will continue to crash once the reality sets in. One reality that has set in today is, and look, before we look at them, Trump is already trying to open the country up before solving the problem. He wants it open by Easter, which is in about 18 days or 17 days. and they can't cure the coronavirus issue in 17 days. If if the whole country was on lockdown for that 17 days, they might curb the growth of the virus from 30% per day down to like 10% per day. Then they would need another 30 days, and then they'd be in a healthy environment to open up the economy little by little, starting with low risk factories where people aren't touching each other or dealing with each other, and then you open up slowly. So this is a gross mistake, that you can think you can do better than China, because China just had martial law and they forced everyone to be in their house for 6 weeks, and they're barely opening the economy now, where the U.S., only half of the U.S. is closed, and they're going to try and open up in 18 days. Makes no sense whatsoever. So some proof: Cheesecake Factory has over 300 stores in the United States, and they have just told their landlords they are not able to pay rent in April. So within a month, all 300 locations are not going to be paying rent. Now, who are they paying rent to? Most likely Simon Property Group, which owns a bunch of malls, and other companies. So Simon Property Group, there they are. They own a lot of malls in the United States. So they're going to tell Simon, in 300 locations, we're not paying you rent. And the economy is supposed to go back up. Makes no sense. So Simon Property Group was 122 US dollars on 2 March. Now they're $62. And in the last 5 days, they actually went from $48 to $62. It's going to go back down because Cheesecake Factory is the only ones telling the truth right now. There's probably another 500 businesses that are in malls that can't pay their rent in, if not April, then May or June. So that's point one. U.S. putting troops at the Canadian border. The border's already closed. They want to put troops at the border to stop Canadians from coming to the U.S. I'm a Canadian. I'm not sure why a Canadian would want to go to the U.S. right now. The dollar is way stronger than our dollar, so everything costs almost 50% more, or 30% more. So why would someone want to go to the U.S. for that? Number two, if you get sick, you have to pay. So the cost of a coronavirus test was like $1,000, and the cost, there was this report out that there was a girl who stayed at the hospital and it cost her $30,000 to cure coronavirus, and it's just a fever and pneumonia, serious fever and pneumonia, but they're not doing any surgery or anything. So yeah, they can put troops at the border if they want. I don't see that as an issue, but it's a bad sign, politically. Rent a center. If they are what I think they are, these guys are predatory lenders. So in my opinion, Rent a Center is a company that lets you buy TVs, couches, everything on credit. People that can't afford a couch or a TV and need to finance it usually have bad credit, bad work history, and so Rent a Center, obviously, when the market drops like this, people with bad credit aren't going to pay. So what they're doing is they're going to draw $118 million from their line of credit to increase their cash balance, and they're going to use that to, I have no idea, maybe do collections. No one's going to go out and rent things from them if they can't even leave their house. They can't shop. So next, NCR, they do POS systems and technology setups for businesses. If your business is closed, you might want to cancel your subscriptions just to save money. So NCR is drawing a $630 million line of credit. Who's going to pay for all of these things, right? There's hundreds of thousands of businesses in the States. Lululemon, their sales growth has curbed, so they're actually telling the truth. U.S. cases. So we already talked about it. The U.S. now leads the world in coronavirus cases. They have global deaths are at 24,000. A week ago, they're at 12,000. The U.S. had 1,100 fatalities, and cases in Canada have surged 72%. That's terrible. So that's the problem right now. Madrid. So the local government in Madrid pledges action as nursing home deaths rise. In Spain, total fatalities are 4,000, so Spain is going to end up being like Italy. They have over 52,000 elderly in nursing homes. One of the things they did in Canada is family cannot visit their loved ones right now in nursing homes to avoid the spread of the virus, which is a good thing, but it's hard on mental health. It's very hard on mental health for families. Lear. So Lear is an automotive company. I believe they do the Lear jets. They are drawing $1 billion on their line of credit from their 1.75, and they're going to use that as cash. So it looks like all of the businesses, actually it's not, doesn't look like, most of the businesses are pulling money from their line of credit to spur the growth or to carry them over until this is done. They are depending on the U.S. system to solve the problem for all of us so that they can get back to making money. It's not happening right now at the pace the U.S. is growing at. The issues is growing in the U.S. It's just not happening right now. So General Motors, this is creative. They're going to cut everyone's pay by 20%, everyone that's on salary, and that would be better than laying everyone off. Those who can't work from home will take a paid leave of absence with 75% of their pay and maintain their health care benefits. The problem with this, if GM doesn't have enough cash, they're not going to be able to do this for a sustained period of time. I have a feeling GM is better off than the average business, but we can look at them right now. So General Motors balance sheet. Cash and cash equivalents. We're looking at 15 billion in cash. So General Motors did learn from 2008 when they went bankrupt and they had to get bailed out by the US government and the Canadian government. They actually used the Canada Pension Plan to give General Motors millions, hundreds of millions of dollars. So instead of paying out dividends and drying out the balance sheet, it looks like they've been shoring up their balance sheet. They have 20 billion in cash and cash equivalents. Now, their total assets is 74 billion, or their total assets is 220 billion. Their enterprise value is 120, so that means they have a lot of debt. So long-term debt, they're actually managing the company very well. General Motors is actually, it's very impressive because their product is not as impressive. So GM stock, just look at the snapshot. If you look at the chart of GM, tanking. It doesn't matter what you do right now in this market, everything's tanking. So GM was at, let's do 3 months. GM was at $36. They dipped all the way down to $14 and they're back up to 20, but this is a healthy company. They can at least pay, they're going to be able to pay their employees for the next 3 to 6 months. Eventually, once the cash burn gets to a certain percentage, they might just say, you know what, we tried everything we can. Then they start laying people off. But GM, good on them. I'm impressed. So now let's look at what's really going on in the market. So we saw what's going on in the day. Everything is good in the last couple days. Now we saw what's going on year to date. So we still need to get up 18% just to get back to zero. Year to date, possibility of that happening in the next month, really slim. Like we could bounce up to that, but we're going to go back down just because of the conditions of the market and the problem with the pandemic. So if you look at the S&P 500, I actually pulled data dating back from January 2nd, 1962, all the way till today. So on average, I've already done the math. So on average, the daily return of the S&P 500 is 34 basis points, or 1/3% per day, up or down. That is the average return of the market. Now the average positive return, because there are a lot of days where there was zero, so this 34 spread over, the average positive daily return is 0.65%. The average negative daily return is 0.65%. That's when volatility is normal. So out of the 16,000 days, just one second, 14,000 days. So out of the 14,657 days, 80 or 79% of those days, which is more than the normal standard deviation, 79% of the days fell between a negative 1% gain and a positive 1% gain. Then 95% of the data fell between a negative 2% and a positive 2%, which means that the S&P 500 is not a very volatile stock from day to day. If you have $1 million, 1% move, or actually 34 basis points. So on $1 million, the 34 basis points is going to be $3,500 is when you're going up or down. That's not bad at all. On a positive day, the average positive day, you're going to go up 6,500 or down $6,900. Now, because the VIX is at 50, which we already went, or 60, if you take this data and you only look at the past month, that's not what I want. I actually just want the last 30 days. So how could I do that? Let's say between. So the last 30 days would probably be between 12 so let's just count this, 31 days. That's fine. Okay, so like I was saying, the average return is 34 basis points. The average positive return is 65 basis points. Now, if we look at the volatility of this data set, which is the last 30 days, it's actually very similar. But the average return was negative 34 basis points. So on average, every single day on $1 million portfolio, you're losing $3,500 every day. That was the average. Now, the highest was a negative 6% day. So 60K gone in a day. And the average or the highest gain was 5.2%. So in this data set, you're seeing that the market is bearish in the last 30 days of the S&P 500, which is the 500 biggest companies in the world. If you break it down into different sectors of the market, there are some sectors that got crushed, like real estate. So these are not good numbers. So that's why no matter what, so we're looking at, the last 2-3 days. So if we look at the last 3 days, 4% gain, 1% gain, 5% gain. everyone is looking at these 3 days. They're zooming in on these 3 days and saying, you know what, the market is on fire, right? The market is on fire. The bear market is over because these 3 days are positive. So maybe I should change all of my outlook and go back to going long the market. Cool. If you want to do that, you can do that. But I just showed you on average, we're losing a third of a percent a day, right? So if you go with the last 10 days, on the last 10 days, you're losing 8 basis points, or 11 days. Let me put this back to normal. So if we want to look at the average daily gain, so the days that were greater than 0, there's 15 days that were greater than 0, I think. So 16 days that were greater than 0, they averaged 1.95%. So days greater, say gains. Right? So gains, the average day is 1.95%. Now, if you do the opposite, days that were less than 0, there's 15 days that were less than 0. The average loss was what, 2.79? 2.79. Right? So we had 16 days where you gained 1.95 and 15 days where you lost 2.79. So the sum of that is negative 41%. And the gains, I didn't get that one. The sum of the gains was positive 31%. So if you lose, so you're losing right there, right? Now, if you're down 30%, I don't know if this is going to work. Here we go. So we know right now that the S&P 500, right, year to date is negative 18.5%. So if you're down, let's say 20%. So if you're down 20%, you have to gain 25% just to break even. If you're down 30%, which we were a couple days ago, you have to gain 43% to break even. So when you look at all of these markets are going down, all of them. All of them are down, all of them are going down. Do you think that the odds are America is going to be the only market in the world that rebounds in the next month? Meanwhile, we have Russia. Russia can't make what they used to make because oil is now $20 a barrel, and that's what they do, right? Germany can't make what they used to make because they're on lockdown. India can't make what they used to make because they're on lockdown as well. Where's India? Jakarta. They're down 30%, right? So they have to make 43%. They're on lockdown right now. So there's 1 billion people in the world on lockdown, not working unless they're on a tech company working from home. So the U.S. pumps $2 trillion into the market. That can't lift the whole world because U.S. dollars is the world's global currency. The U.S. trades. They import a lot. They export a lot. There's no way that this market is a bull market right now or rebounding. In my opinion, I could be wrong, but I doubt it right now. And so, what do you do? Do you follow the numbers? Do you want to go another 30 days and lose on average 34% or 0.34% per day? You can go long the market and lose 0.34% per day on average based on the statistical analysis of the last 30 days, or you can move to cash, you can short the market, you can buy puts to bounce off your longs, or you can buy what the US is buying. So the US Treasury so the Fed is buying Treasury bonds, of course. So the Fed is buying Treasury bonds every day. They're buying, I think, 60 billion in bonds. So when inflation is rising, I would not buy JNK. I would not buy junk bonds. But when inflation is rising, bonds go up. Why? One is because the Fed is buying bonds. Two is because stocks are not reliable, so people buy bonds. If I was going to make an investment today that was long and not short, I would be buying Treasury bonds, possibly gold, but only when the VIX is down or when bonds dip. So on a day that bonds dip, I would be buying bonds. That's the only thing that I could go long in my portfolio right now is bonds and gold. Every other opportunity, when the market is up, I would sell my positions, or when the market is up, I would short those positions. So if you look at today, what went up today, I can look at what I'm looking at. So I have 64 stocks in my watch list. I would just go here and say Bridgemark, they're a real estate company for Royal LePage. They own Royal LePage. I may not short them. Mortgages, up 30% in a day, makes no sense. I would get rid of, all of those companies that I own that are related to debt. So I would look at these companies and say, you know what, when they get to the top of their range, I'm going to short them. And if I own them, every time they bounce, I'm going to sell them. That way I get out. Norwegian Cruise Lines is heading straight towards zero until the government buys them. So that's my outlook on the market today. Today is the 26th of March. We will see what happens in the coming weeks, months, year. But as of today, I'm bearish on the market. The data tells me that the market is going down further. Once we see some countries recover that are not just China, once we 3, 4, 5, 6, 7 countries say we're on a decline and we beat coronavirus, or maybe we have a vaccine and the vaccine is tested and approved and ready to go, and then it's being made in the millions. Okay, but as of right now, this is why I'm short the market, and I don't see any evidence of why I should be long the market. That is my market update.